Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He covers the gold and silver market extensively. He runs a physical gold and silver storage vault, also a retail bullion online dealer. The gold price has rallied a lot the last couple months, despite the narrative in the mainstream financial media that the Fed cutting rates would be bad for gold. The opposite has happened. Shockingly, the mainstream financial media is wrong. And then now they're going to start backtracking. The gold price is still above 2,700. It's rallied a lot in just the last couple months. Shockingly, the silver price has done even better than that. The silver price is above $33 when we're recording this interview on Monday, October 21st, 2024. The silver price is at $33.75. I'm bringing back my guest, Bob Coleman. He's been in the investment management industry since 1992. He founded Profit Plus Capital Management, a registered investment advisor, also the Idaho Armored Vaults, which stores physical gold and silver, insurance, physical storage, unlike some of the other companies out there. Bob, thank you for joining me again.
Yeah, good, Jason. How you doing?
Doing great. I mean, this should be a good time for gold and silver investors, don't you think?
It's definitely very exciting. I think one of the things with the metals, it tends to be a very emotional asset class, and obviously we've had a lot of political developments with the election coming up, and the divisiveness that you kind of see, and the rhetoric that you kind of see, that goes along with not just the presidential election but the congressional election. And I think that's sort of been the driver, I guess you could say, that people are trying to sort of, not necessarily the stacker. It's really the investor out there and the professional investor, the money manager that's starting to sort of see the metals for what they can provide as a store of value, but do it in a way where it's a neutral reserve asset. So you're not really playing the idea of something that's correlated with the stock market as much as this is something that could be correlated more with political risk or some type of obviously, like with the elections and so forth in the Middle East, some event driven type of risk.
Okay, so by reserve asset, you mean that the central banks don't have a lot of options for allocating their their foreign exchange reserves, which are their accumulated trade surpluses. Normally, the largest areas for central banks to invest historically are either U.S. Treasuries or gold. And I would argue, based on the data, and we're seeing a lot of the data still come out, that central banks, I think the surveys for central banks, I think I saw either World Gold Council or Kitco survey in the last week or two, say that central banks do not plan on slowing down their physical gold tonnage, their monthly dollar cost averaging accumulation purchases. That 81% of central bankers surveyed plan on accumulating gold. The data also shows, Bob, that instead of accumulating, buying more U.S. Treasuries, they're buying physical gold tonnage instead.
Yeah, I mean, there's still obviously a lot of buying of U.S. Treasuries. You kind of see it in some of the tick report numbers and so forth. But I think the big thing right now is China has slowed down quite a bit, on official status from the spring. But the big player in the market has been India. Just with the reduction of tariffs announced in July, moving the tariffs from 15% down to 5% on gold and silver, and from 15.6% to 5.6% in platinum. You saw, I think August, or no, I'm sorry, September. I think that was the largest September on record for precious metals buying in India. And they had an enormous August as well. So
Is that
that
retail? Who's which segment of the Indian market?
it may be just overall a kind of a combination, because you have Diwali coming up, which is their festival season, but at the same time you have a lot of industrial demand, obviously with solar and photovoltaic type of usages, that type of thing. So that's been they've been building out their solar panel industry. So you probably have a combination of the two.
Photovoltaic, you mean? Yeah, we're gonna have people in the comment section like spell it out for you in the phonetics. We're gonna have some grammar Nazis are gonna be in the comment section now.
Sure, sure.
But I think what the market, I think there's a paradigm shift here, Bob. I think that's something you just highlighted. And I would say the real new demand driver the last 12 months, really since I think October, about a year ago, is this Asian retail demand. So China, India, Japan, Korea, Thailand, Vietnam, the retail investors in those countries, because those currencies have been a lot weaker against the dollar. Then you have the tax law change, as you mentioned in India. You also have the tax law change, I think, that a lot of people weren't aware of January of this year, 2024. The Japan put a new law in for people's retirement accounts. I think for the affluent in Japan, I think the first $100,000 of physical gold they buy into their retirement accounts tax free. So I mean,
Oh,
I think that
I didn't know that.
yeah. So the Japanese gold demand has really started to pick up, and then you have what the yen getting absolutely taken to the woodshed for a lot of this year. So that's sparked a lot of demand for gold in Japan that just wasn't there before.
Yeah, and obviously the BRICS thing, yeah, it may be more of a sort of a headliner type of thing versus because a lot of the BRICS countries, their currencies have been, you know, underperforming against the dollar. And I think, the BRICS, I think, are just trying to find a way to try to reduce the friction risk of or the friction costs of dealing with dollars. So they could try to support their economies. But there's a lot of there the biggest driver I think right now, besides like you were just mentioning, is really the financial markets in the US. You've had a lot of money that was going into derivatives, the futures contracts. The option market has been just absolutely on fire. ETF flows have started to come back into the market, unlike the spring where the silver ETF, silver kind of catapulted from 22 up to about, $30 or so. And you didn't really see any inflows into SLV. This time around, in September and so forth, you started to see, you know, very large inflows starting in August, continually coming in. And so that's been supportive of the markets. With interest rates as high as they are, you've had this wider contango of the futures market relative to the spot price of the physical market. So, to kind of put this in plain English, back in September when we rolled out of the August contract, you could have sold and got about $35 premium for gold if you bought the spot price and sold the futures price about 3 months out, and which gave you I think about a 5% or so return if you did that on a periodic basis. Just rolled the contracts, and so that higher interest rate started to attract people back into the markets to capture that contango or sort of financing rate. But that's and then you had the options market just in terms of volumes and so forth just explode. A lot of professional players using the options market as a way to gain exposure to the precious metals world because with options it's not just simply a play on price, it's also a play on volatility as well, and volatility happened to be very, very low in the metals markets for quite some time. So there was a lot of trading desks and professional investors started to look at saying, listen, I think if the metals start to get some bids here and prices start to rise, volatility could start to increase as well. So there's a sort of a beneficial effect, I guess, on sort of a market that's starting to attract more and more money.
Are you talking about like kind of a gamma squeeze, like where they're hedging the bullion dealers or others that were short gold and silver futures contracts are having to hedge at higher prices?
Well, I mean, there's a little bit of that going on because you've had the I think it was announced in August where the CME was going to basically limit starting after January 1st that any good delivery bullion bars had to have the date stamped right onto the bar. So you had this sort of rush, I think, of metal coming onto the CME or the COMEX, in August and September. And what they did was they put the metal into their clearing account and then sold contracts against that, to capture that contango. And I wrote about this on a post on X or Twitter, how that could actually turn into a little bit of a short squeeze, because all of a sudden now these players that have dumped metal into the exchange, um, and have sold futures contracts against it, um, now ultimately have to buy back those futures contracts when it comes time for the roll. And what's kind of happened here as the market is sort of, the Fed started cutting rates in September. That actually started off a little bit of a chain reaction where all of a sudden people that were playing this roll game where they were capturing the contango, the higher futures price in the future, they were selling that and capturing that spread. All of a sudden, when the Fed started cutting rates, you started to see players actually start to close out that December contract and start to sell the March contract. So it started adding pressure or buying pressure into the market in the December contract, and that started to actually lift the price a little bit, even though they were selling the March contract, which is not as actively traded. But it's these types of things that actually can create some of these price movements.
So for some of our listeners who are not familiar with the futures market or new to financing, you're saying that the futures contract price was higher than the metal price. So if they wanted to go buy an ounce of bullion, it would have been cheaper than the future contract price 8 months from now.
Yeah, so for example, let's say gold was at 2,500 on the spot market. You could have you could have bought the spot price at 2,500 and sold the December contract at 2,530, and you could have just locked in that spread. So, on paper, so to speak, you're just buying at one price, selling at another, and yeah, there it's sort of a risk-free arbitrage, I guess you could say, because the idea is that you can always deliver that spot metal into the futures price or into the futures contract at the time of delivery. So it's more of a financial.
Does that risk free arbitrage though? Does that always work out, or it blows up? It turns into a short squeeze, like you said, though, right? At some point.
It can blow up, and in March of 2020, what happened was when you had that sort of the exchange for physical premium, which is basically the spread between the London market and the New York COMEX market, the futures market. Typically, what happens is as you get closer and closer to the expiration of a futures contract, the premium drops lower and lower and lower. You don't have that time and the cost of storage and that type of thing that gives you that buffer or that increased premium in the futures price. The problem you had in March of 2020 is when everything shut down and all of a sudden these physical players were long physical, but they were short the futures as a hedge. And then all of a sudden you had the shipping uh, sort of transportation network shut down, mines shut down. All of a sudden, those physical players couldn't get physical. They all rushed to cover their shorts on the futures market, and you saw this sort of exponential move in the New York COMEX contracts on gold and silver, for example, mainly on gold, go from maybe a $10 premium to $76 premium overnight, and you saw millions of dollars lost by banks that basically made a market in that exchange for physical premium market. Um, and I apologize if I'm kind of getting into the weeds here on how all this stuff works, but basically what happens is when you get an extraneous event, it can create these odd moves in price that many have a hard time understanding or explaining.
It's similar to a margin call, so it's a short squeeze. So the banks have to come up with the metal, and then you're saying that the metal has a higher premium. I think another thing that we saw too, and it started, I want to say like October of last year too, was that there was at one point, a huge price differential with the premiums and the spot price in China for the Shanghai Gold Exchange for physical gold and silver, and in the markups there for retail investors to buy bullion versus the American price. I think at one point the silver prices were $4 to $6 an ounce difference between buying it in China and here in the U.S. And in gold, I think it was might have been $100 to $150 differential. There was a huge differential. Now I think it's come down, but the spread, the arbitrage was absolutely very, very large. If you could move the bullion from London or New York to China to sell.
Yeah, I mean, yeah, and I think a number of people kind of wrote a lot of articles about that. One of the caveats to that though was that if you were a bank, and a lot of banks were actually trying to get U.S. banks are trying to get into the Chinese market to take advantage of that premium. The problem that you ran into those, you had to do the transaction and hold the currency in the Chinese currency. So in essence, part of that premium was actually sort of a risk a risk premium to holding Chinese currency and the volatility of that currency, because it
Oh,
wasn't just simply dumping. Yeah, it
you're
wasn't
talking
simply
about
doing
their
every.
you're talking about their capital controls, right? Because like if you make a profit in China, so you do a deal like that in China, it's not easy to get all your capital out of the country then.
Right, right, and yeah, and at the same time, you can't export. Well, once the gold goes into the China proper, not into the exchange, or sorry, the foreign free trade zone, but once it goes into China, you can't get it back out. So all these transactions were really based more in the yuan, and a lot of players were forced to hold one. Of course, the question then is the volatility of, you had a meltdown in the real estate market. The stock markets were going down. They were talking about potentially debasing the currency to try to, like many other countries are doing, to try and give a shot or a boost to the economy. So all those types of things, you needed, if you're going to do business in the gold market, you needed to have some buffer or premium to deal with the other side, the currency volatility.
Yeah, and then you have the capital controls, which are enormous pain in the butt. I mean, it's very difficult for a lot of investors or banks or other businesses to get all their capital out of China once it's in there, especially on a large deal like that for many millions of dollars or a large investment. So we're seeing that now with a lot of the rules changes with the Chinese Communist Party and the capital controls. I think some of the entities, I think I saw on business TV that Mark Mobius, he was a huge China investor for emerging markets and elsewhere. He said that his capital was trapped for a while for his investments in China, but then they changed the rules and he was able to get a lot of it out. But now he's going back in. So I don't know. It just sounds like a lot of confusion and headache to me. Bob, your expertise for listeners out there who aren't familiar with your work, you have 2 decades of experience or over 2 decades of experience in the bullion industry. So dealing with refiners, dealing with wholesalers, dealing with other retail bullion dealers. I want to ask you about the state of retail demand for bullion dealers, for American bullion dealers. Would you say that demand is strong given the prices we're at for gold and silver?
No, in fact, I think it's, at least with one of the big wholesalers that's a publicly traded company. They even have mentioned, I think their numbers are down 40 or 50% from the prior year. So I can imagine that a lot of retail guys out there, earlier this year they were extremely heavy in inventory because people were selling back. Investors becoming disenchanted, especially earlier this year, like in February, January, that type of time frame. You had bids sort of drying up in the market, and it's part of when you watch the retail dealer out there, especially the online guys that put their prices out there. You tend to see, they're buying back 1 ounce rounds or 100-ounce silver bars at $2 and $3 under spot, and these are the biggest guys in the business that are advertising these really crappy bids. At the same time, 2 years ago, they were selling these same products at $5 to $7 to $10 over spot. So the investor was sort of learning a very dark education when it came to the bullion markets, how the the retail environment really took advantage of people buying during the frenzy of 2020 to 2023. And then you sort of had the markets go up a little bit and people just became disenchanted thinking, okay, the prices are just going to come crashing right back down. The whole industry is manipulated, by the banks or whatever it may be. And so the retail has been really selling all the way up, which is something I kind of predicted what would happen. And just really since August, what's kind of helped the industry is you've had this sort of the larger high net worth investor out there buying the market, sort of coming in and buying out certain products where you'd have certain products on the wholesale side would be very poorly bid, or the prices wouldn't be that great, and all of a sudden they'd be wiped out of their inventory. But oddly enough, the premiums never really jumped like they did in 2020 to 2023. So the wholesalers are sort of still seeing this sort of flood or trickle of metal coming back to them, whether it's from the IRA industry or if it's just from normal retail investors that are saying, listen, the metals now have become a source of funds. And you have to remember, people have held the metals for 10, 20 years. And especially since the great financial crisis in '08, they're now saying, listen, I can finally break even, or I can make some money on this thing. And my lifestyle has changed where I need income. I can't rely on the price appreciation anymore like I used to. And so that has also influenced, I think, some of the activity in the retail space as well.
Yeah, I think there's a mix of people that are selling for retail investors. It's a mix of people. Some people are giving up, saying like, well, silver's not at $50 or $100. Like the marketing material for some of these bullion dealers or some of these other newsletter writers have been predicting for many years. So you have people that are saying, well, now I have a little bit of a profit because they bought silver at the top, like you said, when silver was screaming in 2011, or in 2020, when 2021, I think, when silver had a huge rally from 2020 to 2021. So some people are cashing out, saying I've had enough of this roller coaster. The other group is the people that desperately need the cash because of inflation, or they lost their job, they can't, or they've replaced it with like a lower paying job or a couple part-time jobs. So they just need to liquidate the assets. They need the cash to pay bills or try to maintain their standard of living. I think there's a lot of that.
Yeah, you have to remember, I mean, the premium structure between 2020 and 2023 was obscene. I mean, you had Silver Eagles being sold by retail dealers for $20 over spot. There are a lot of people out there that still are nowhere near break even with silver at, plus $33 an ounce. A lot of people that bought, at 25, for example, and they bought silver maple leafs may have paid eight, nine, $10 over spot. They're still underwater because now a lot of these products are going discounts to spot by the same retail dealers that were selling them at $10 over spot. So that's been something that I think the industry should have done a much better job. Balancing themselves, instead of profiteering off the consumer base, trying to create a more a market that is seen more as an investment rather than just some commodity. That because now I think people are kind of realizing, hey, there's a lot more risk to owning metals because of these spreads and so forth. And of course, then you have a lot of these California dealers and guys that have been in the on the news that basically siphon people's money. Never, people placed orders, never got their metals. You're talking tens of millions, hundreds of millions of dollars of people's money just basically stolen. And of course, then you had obviously the first state depository thing where you had, over, I think it was the CFTC was saying $113 million in losses or something like that, where basically the owner was, I think, accused of basically taking metal out of people's boxes for 10 years. And that now is drawing in class action suits to the IRA custodian world, because these IRA custodians, the idea is that they're sort of a fiduciary, that they have some responsibility to know who they're dealing with on behalf of their customer, because they sort of have that trustee type of relationship, because the client can't actually control their own money in an IRA. So you have that going on at the same time. So there's a lot of in the U.S. there's a lot of sort of moving parts that are sort of affecting the retail world right now.
Now, a couple minutes ago, you mentioned the wholesaler that's publicly traded. Excuse me. For our listeners out there, that company is AMark, A and then the space MARK. That's the company. If our listeners want to go check out their financial results. So, AMark, could you talk a little bit about AMark? So, they do wholesale, and then they also own retail investor bullion, and they own some mints and they own some refineries. They're kind of like the big powerhouse, multiple stage of the supply channel there.
Yeah, they are definitely the kingpin of the industry. I mean, they have sort of bought a lot of retail dealers like JM Bullion, Provident, Gold. I think Gold Line, Silver Gold Bulls. There's a lot of dealers that they've kind of invested in or own 100% of, and then of course, in 2020 they bought an interest in Sunshine Mint, increased that interest to I think 45% or so. And then of course they own Silvertown. Recently, it was just announced that Silvertown bought Regency Mint in Utah, which that mint makes a lot of private label product for other bullion dealers, that type of thing. So you have this sort of AMark is sort of kind of becoming a real powerhouse or behemoth in the industry that sort of has a lot of footholds in different markets. And I think that's the advantage of a publicly traded company because obviously they have a lot more access to capital.
Well, also, we're getting the information from them. And you said earlier, and I've seen this elsewhere, I've been speaking to other industry contacts too, and their information, their sales are trending downward. So, despite this rally in gold and silver prices, their retail investor sales largely, maybe other than Costco, and I don't think AMark sells directly to Costco, their sales are downward, trending down.
Yeah. Yeah, and it's something that this may get off topic a little bit, but it's something that I try to educate the public on, especially through my Twitter or X handle, is a lot of gold dealers that own depositories really built their model. Their business model is based off volume of transactions. That they kind of relied on the higher markups on the transaction, and they gave away the storage in order to get that transactional business. The problem you're running into in today's world is the transactional business has dropped, the premium structure has dropped, and they're still giving away the depository accounts or the storage fees are still very, very low. In some cases, there's no way they can make money offering storage, insured storage, and so now you're running the risk, or there's risks building within the industry that as the parent company that is sort of the cash flow business that supports all these ancillary businesses, whether it's leasing or loans or storage or other types of businesses, um, that becomes more of a business model risk that depositors don't really fully understand, because a lot of times when they have a storage agreement with a depository, they're thinking they're with that gold dealer, but in reality, how it's structured is they have an agreement with the depository LLC company, which is maybe a subsidiary or affiliated company of the gold dealer. It may not have the balance sheet that the dealer has, and all of a sudden, something does go awry or go wrong. There's really not that balance sheet to provide, liquidity of, like, for example, if there's a loss and they have a high deductible on their all risk policy, all of a sudden, they could be cash flow poor, trying to cover just the deductible on the loss of the metals. I mean, there's a lot of nuances I think the public needs to kind of understand of what's happening, because this is a very unregulated environment or industry. There's basically everything is sort of the Wild West in a way. There's no oversight there's very little transparency or accountability.
And for our listeners out there who were not here during the bear market, there was a lot of retail bullion dealers that went bankrupt during the bear market. I think there was Bullion Direct, Tolving, and then there was one or two others. Like Northwest Territorial Mint, I think was one. They're all for different reasons, but maybe they got their sales volume went down or they got stuck or they were doing some type of scam one way or another. But I think that's an important point you mentioned with the transactional sales volume. So, for example, then what you're saying then, Bob, is that in the past, a bullion dealer would maybe for a retail bullion dealer would sell $5,000 or $10,000 worth of gold and silver to someone. Are you saying that that's down enormously compared to the past, then their total sales?
Yeah, I think that if you look at the number of transactions, the ticket count per se is way down from where it was, the last 3 years. And I think that's on top of that, the premium structure is way down from where it was as well. So basically, for example, this push by A-Mark to buy, or Silvertown, which is their subsidiary that bought Regency Mint, uh, you know A-Mark is really building a very big powerhouse base of minters, or of making 1 ounce proprietary product, or private label product, as maybe a way they see to try to maybe increase profit margins. And so, for example, then this is a good example. JM Bullion just announced a partnership with Zero Hedge, which a lot of people obviously go onto Zero Hedge to get news and information, and a lot of gold dealers used to write a lot of articles to put it on Zero Hedge, because a lot of people that
Free
like that alt.
advertising, yeah.
Yeah, exactly. Yeah, and that was the model. Well, that model just got disrupted because JM Bullion is now having, they're making private label product, Zero Hedge 1 ounce rounds.
And you
And
said
there's
they paid for ad space all over the website.
yeah, and there's banners everywhere. So every article that gets pumped out on Zero Hedge, there's 2 or 3 banners of JM Bullion right there. So that kind of defeats the purpose of a gold dealer to kind of provide an article that may be designed for advertising, but now it's kind of being thwarted because you're having JM Bullion plastered all over their article.
Yeah, so if you're like AppMax or some of the other large Gainesville Coin, some of the other larger bullion dealers, then you're at a disadvantage on Zero Hedge then because you're not going to get the traffic generation because it looks like Amark and their retail bullion dealer paid for preferential treatment.
Yeah, and so when you start to see that, the game is changing. I mean, obviously, just like with search engine optimization and trying to understand that game, and the constant changes that Google makes to their algorithms and so forth, you're starting to see the same thing starting to happen as transaction volume has diminished. Everyone is trying to get that smaller piece of the pie. And you may have premium wars that have developed the last couple months, especially over the summer as action got really quiet. These are all things that typically happen after you have a massive profit stage of, like, for the last 3 years. 2020 to 23 was probably the most profitable time for the industry, probably on record. And now a lot of people jumped into the game. They thought it would continue. You had a lot of private refiners jump in, or private minters jump into the game in 2021, 2022, build out. They went into operation in 2023. The market kind of fell out of bed. And so these are all things that start to kind of unfold, and as the pie starts to shrink, that puts pressure on margins and obviously on trying to grab that business.
Well, it looks like Amark though is focused on a long-term strategy of like consolidation and gaining market share. And then I think you said that they're focused then after they consolidate more of the industry with bullion dealers and get more of the supply channel and the value chain. So bullion dealers, retail bullion dealers, they're a wholesaler already. So they're going to buy retail bullion dealers, they're going to buy mints, they're going to buy refineries then. And then once they have control over the supply chain, the value chain, and larger market share, then they're going to have pricing power. Is that what you're saying? It appears to be their strategy.
Yeah, because if you really look at it, and this is something that was really prevalent in 2020, after the sort of the investment that they made into Sunshine Mint as well as Silvertown, there's a much wider spread between buying 1,000 ounce bar, taking it through the minting process, making it into 1 ounce rounds, and then selling it to the retail public. They can capture that wider spread rather than just simply being the wholesaler or being the retail dealer and paying these markups. They're sort of trying to go after that entire premium structure, if that makes sense.
Well, it would make sense to own the mints and the refineries because then you could deal with all the industrial demand users. So, like a Samsung or one of these other tech companies that need silver for electronics or solar panels, they could go directly to AMark and negotiate some type of contract to make their specific silver.
Yeah, definitely. And you're right. And a lot of times, you know, it's a different product altogether. You know, it may be shot, it may be just the bars, it may be, other types of products, industrial products that they or even fineness requirements that they need. So you're right. They're definitely maybe they're seeing the idea that, hey, there's a demand for silver that's not just going to be retail oriented. It may also be industrial, rising industrial demand as well.
But it doesn't sound like it's a good business to go into if people are seeing like, oh, the gold price is almost going to 3,000. Oh, it's going to go to 3,200, 3,500 quickly. Oh, silver is going to go to 40 or 50. People see those price action. They'll think, oh, I'm going to get into the retail bullion business. I'm going to start my own retail bullion dealer. You're saying that that's not a good idea then.
It's not. That sort of business model, I think, kind of peaked in late 2022 when you had, when you saw the full page ad, I think, put out by APMEX, about them buying back Silver Eagles at $10 over spot at the time when they were selling them at $20 over spot. I think that was the epitome of the top of the retail business model, I guess, or profit margin model. And since then, it's been sort of just declining, I guess you could say. You get these periods of pockets of strength, but you're not getting a sustained, consistent strength like you saw from 2020 to 2023.
So for our listeners out there, and I get asked this all the time, they're always looking to buy bullion. People are always looking to get prices close to spot price. But if you're a retail investor, normally you're getting offered, at least on a lot of the online bullion dealers, there's normally markups on premiums. How do you, Bob, go and look for coins or bars at low premiums?
Yeah, I mean, we actually have on our site, we sell product as well, and we've always been one of the lowest. I've been selling product to clients since 2009. We've always been one of the lowest in the industry, period. I have to remember, my business model is basically completely different than everyone else in the industry. I'm actually a registered investment advisor, and I come with that mentality of, hey, listen, the client comes first. You sort of a best interest type of mentality to the client, because I want to build the relationship. I'm not in it to simply, maximize my profit on the transaction. So that, 2020 to 2023, or my premiums on silver products were on average $3 to $5 less than any other major online dealer out there. And we were able to do that because we just didn't mark it up. We wanted to provide sort of that respect to the customer, because at the end of the day, they're the ones who really make this industry work. And I've been very vocal about that, outspoken in terms of how much over premiums people were paying, and sort of the sort of misleading and misinformation that was out there by promoters and dealers in terms of using different types of marketing ploys and fear mongering tactics to try and gain business. It's definitely worth it for people to shop around. People certainly want to just look at what we sell for. They certainly could. We have on our goldsilvervault.com site, we have a section for buying metals where people can actually look at the price action right there. They see what the quote is for the product, and they can at least then compare to other dealers out there. But certainly with a lot of backdated product now coming back onto the market, that's made it a little bit more challenging, I think, or more competitive, I should say, for the retail buyer to say, listen, I don't need to buy brand new product anymore. Whereas in 2020 to 2023, it was a one-way street, basically, where at 9 out of every 10 transactions were purchases. In today's world, it may be 50-50 or 60-40, where you have a lot more selling that's coming into the market.
Yeah, I mean, normally the premiums are the highest for the American Silver Eagle coins. Is that because of the way the U.S. Mint, how inefficient it is, and then how they mark up the price for the authorized purchasers, and then there's excuse me, and then there's middlemen, and then by the time the retail investor buys, what it's been marked up two, three, four times between the U.S. Mint, the authorized purchasers, and then the middlemen.
Yeah, I mean you have to remember that the U.S. Mint announced that I think earlier this year they were raising the price on the premium to their distributors from $2.95 over per coin to $3.05. So basically, the moment that coin's made by the mint, they're selling it to their authorized purchaser for $3.05 over spot. And so what's happened is, and you have to remember, there's been a lot less Silver Eagles made in the last 3 years or so, 3 or 4 years, than there had been. In 2011, 12, 13, there was 2 to 3 times as much Silver Eagles made back then than there was, in today's market. So what people may not understand is there's a lot more Silver Eagles, backdated Silver Eagles out there that are waiting to potentially come to market, and that has actually been the case, and so that selling has really dampened the premiums on the Silver Eagles, even though the mint has is not making nearly as much as they used to. And that the Silver
Wait,
Eagles.
Do,
Sorry.
do you mean, sorry to interrupt you. I got confused here. Do you mean the dampening of the premium? Is that on the new Silver Eagles that are made each year? So the 2022, 2023, and then 2024 Silver Eagles, those are going to have lower premiums? Or do you mean the older Silver Eagles, say the ones from like 2009, 10, 11, 12, 13?
No, they're all the premiums have all come down on them. Like for example, I think we're like a little over $4 over spot for Silver Eagles, brand new Silver Eagles, 2024s, that we have on our site. But the way the wholesale industry works, there's really not much difference between a 2009 and a 2020 Silver Eagle. Retail dealers may try to sell certain years at higher premiums, but that's just all marketing. Because there may not be a lot of Silver Eagles of 2007 sealed boxes out there, so they can try to mark those things up. For the guy who's a collector that says, "Listen, I want to have a box of every year." That's sort of the idea that a lot of dealers will try to take advantage of. But in essence, when you're selling back into the market, the wholesale price, they're going to pay you basically the spot price of what a brand new year would be, like a 2024, and then everything else is backdated. So most of the other products are all going to be maybe just a little bit lower price, but you're only talking maybe 5, 10, 15 cents difference between backdated Silver Eagles and brand new Silver Eagles.
Yeah, and the cheapest prices I've seen for American Silver Eagles on online bullion dealers, they say that if you don't care what year you're buying. So it's like you're buying a mixed bag. So if you buy like, say, a dozen Silver Eagles, you're getting mixed years, and then that gets you the best price in the mixed bag.
Yeah, yeah, definitely. Because a lot of times what's happening is these retail dealers are buying back product, at spot or discounts to spot. So now what's happening is the industry, which had really big premiums on people buying product between 2020 and 2023. Now what's happening is when people are selling back product, they're getting big discounts to spot. So these retail dealers are making back this profit margin by basically buying back product at a much lesser price, and that's part of what the disdain I think that the retail public is sort of seeing, especially the ones that are saying, "Listen, I need." The metals as a source of funds at this point, and they're selling and they're seeing what they're getting for it, $1.50, $2, $3 under spot, and it's just turning them off. And I think that's the unfortunate thing about an industry that doesn't do a good job of trying to balance itself.
Well, also a lot of retail investors come in who haven't bought silver before, and when the price is going up and the premiums are rising, they panic buy and they think that the prices are going higher, and that's the worst time to buy. But I think the case now, Bob, that you have is you have a lot of overall, according to the Silver Institute and some other studies I've seen. I mean, physical silver demand for retail investors globally, not here in the U.S. for retail investors, but globally in other countries, and then also for industrial demand. I mean, it's still trending higher, and it looks like there's going to be pretty substantial what silver deficits going forward, at least according to the Silver Institute. So overall, the market is looking very good, except for American retail investor demand.
Yeah, and I think it's important just to note for the people that the gold and silver investors out there, retail demand doesn't always really impact the price as much as one would think. It certainly can be one portion of it, but it's the institutional investor, it's the financial markets, the derivatives markets, the futures markets. Options markets, mining stocks, when the market starts to broaden out and money flows start to come into the sector, that money flow can push the price action on the metals just as much as if retail demand came in and started buying out all the existing above ground stocks, for example. It's just that the money flow that we've seen, like for example, week over week in the gold futures market, you had about $12 billion of money flow coming into the gold market week over week last week. I mean, just a massive amount of money flow, and that's driving the market right now. It's not, this, you see a lot of this sort of by promoters and gold dealers about it's bricks. It's, they come up with these stories out of thin air to try and, give people a reason to buy, or sort of a sales reason to maybe make it more attractive that, all these foreign countries are coming in and buying the metals because they're going to make a gold-backed currency. A lot of times it's just money flows coming in and out of the markets. Especially once the metals have kind of caught a bid, you have a lot of momentum traders that come in, and that momentum money can be a lot bigger than the retail public's wallet. So that's
For
what we're kind of
silver,
seeing.
yeah, so for gold, the monthly purchases that are increasing a lot really since the 2022 Russia sanctions, there's been basically a doubling of monthly purchases by non-G7 central banks. So they've been dollar cost averaging their monthly tonnage purchases of physical gold. But for silver, it's different because you have the industrial demand. I mean, like China and India, they just brought online enormous solar farms. I think China's near the Gobi Desert, and India's one I think is like the size of a large city. And then on top of that, I think the data just showed that China has cut their silver exports down by 50%, I think, according to Chinese data that just came out last week or two.
Well, I think China actually exported a lot of silver to India, actually,
Oh, really?
because the Indian numbers were very, very strong, and you had, I think it was like 400 metric tons, or I mean, there was a massive amount of silver that came over from China. So it wasn't, that there's certainly, and that's probably a lot of industrial usage that was happening, but the and I kind of mentioned this back in July when you saw those tariff cuts in India. You know, when you see, basically those tariff cuts basically just cut the price of gold and silver by 10% in India. So you're going to have a natural demand surge, because people that have been waiting to buy now have, they've they're able to buy a lot more metal for their money.
You think that that's going to overall that it's not temporary. So then that the demand is going to be more permanent then with the taxes that they're not going to switch it back.
Yeah, I think it's, well, I should say you're going into Diwali right now, so the this festival season of buying has certainly, it's sort of ignited a fire there. Now the question is, after the season's done, then you want to look at consistency of industrial demand and their solar power industry, how that's building out and so forth. We'll know more and more as we get into the new year. But certainly this massive demand spike could have been also for jewelry and retail demand in India.
And China, I think the picture is a little bit different, although there is also strong demand there for jewelry. There was, I think, earlier this year in April, there was a record amount of cash withdrawal from the Chinese banking system. It hit an all-time high for cash withdrawal. And I think within a month or two of that, I think a month before, there was 40 regional banks in China that failed and needed to be bailed out. Plus, you have the worries in China over their real estate market crashing. A lot of Chinese people don't trust a lot of companies in their own stock market. And then there's the worries of a yuan devaluation if China, and recently we're starting to see some hints that the Chinese government is going to do quantitative easing with debt monetization, print money to bail out their banks, devalue the currency maybe to boost exports or something like that. So there's a lot of worries there. And I think a lot of Chinese people that had a lot of cash in their banking account, checking or savings account, they've been pulling out cash since earlier this year, maybe even starting before that, like at the end of last year in 2023, and buying physical gold and silver instead.
Yeah, no question. I think that was a great summary of probably one of the drivers the last year and a half. That you've seen a lot of Chinese demand for metals.
Well, Bob, I really enjoyed our discussion today. Overall, it sounds like gold and silver demand is increasing, but if people live here in the United States and they're retail investors and at the bullion deal, they're not going to see that from what it sounds like because if they go online and check it out with online bullion dealers, they're probably going to see some pretty good prices now if they shop around.
Yeah, definitely. And that's what I would recommend. Certainly, it pays to do that. I mean, obviously, Costco stepping into the picture has added a totally different mix of competitiveness in the industry that I don't think the industry is really preparing for. But I think, this idea of I think this year has kind of turned into sort of a buyer's market where premiums have certainly come down and volume levels have come down. So it's not as one-sided in favor of the retail dealer.
Okay, and we didn't get a chance to talk about Costco because that's kind of the giant elephant in the room now that no one was expecting the last 12 to 18 months. Can you maybe talk about where is Costco getting this gold from? Are they going directly to A-Mark? Where are they buying the gold bars from that are selling so quickly now in the US Costco wholesale stores?
Yeah, I'm not too sure where they're sourcing. If they have direct relationships like an authorized sort of purchaser for the Royal Canadian Mint or the U.S. Mint, that type of thing, because they certainly have advertised Silver Eagles and Canadian Maple Leafs and things like that. They may be going through they may be going through private refiners or other sort of wholesale bullion dealers or maybe their jewelry uh, refining vendors that have very strong relationships with these refiners, and sort of they maybe going through them to grab product. But it's obviously the I think the difficult thing to understand with Costco is they've never really broken out their metal sales. There's been, I think, one Wells Fargo analyst that made this sort of guesstimate that they sold $200 million a month in gold, but in reality, when he was referring to like the PAMP Swiss bars, for example, I don't think PAMP could make $200 million worth of 1 ounce gold bars on a monthly basis. So some of the stuff there hasn't been any type of accountability for it, and Costco certainly hasn't broken out those numbers like on conference calls, that type of thing.
Okay, so it must not be sizable yet. I mean, I think I've heard that they briefly talked about it, that they are having success selling it, but I think it's fairly new. It's only the last 12 to 18 months. I don't even think they've been doing it for a couple of years. I do not think they have direct relationships yet with a lot of the big players. I mean, if there's retail bullion dealers that are going out of business, so Costco, for our listeners out there, because I covered them as a dividend stock many years ago for my day job as an investment analyst at a newsletter company. They are very astute at buying gray market stuff. So stuff from a wholesaler like clothes or good bottles of wine or jewelry, something with the wholesaler, another wholesaler, or a large chain of stores went out of business. Costco will come in and they will get a huge discount on items and they will market it to their customers and they will make profits off of it. They are very, very good at this business model with different types of products. So it sounds like that could be happening then with gold and silver. Some of these online bullion dealers that Bob was describing that they're having trouble. Costco may be buying this stuff in the secondary market or gray market out of bankruptcy for some of these guys and then reselling it to their customers.
Yeah, that may be that could be the case. But yeah, it's certainly impacting, I think, some of the profit margins because I think a lot of retail buyers, especially over the last few years as premiums were so high, it's almost forced a lot of these retail stackers to say, listen, I've had it. I want to get a better price, and I certainly want to be able to protect my purchasing power rather than give it to the dealer. Because the industry probably made hundreds of millions of dollars on these markups. And I think that's one of the reasons why in 2020 to 2023, you didn't get a breakout in silver price because there was so much profits being made on the markups that you could have got a lot of extra silver taken off the market just as if, uh, you know, if the markups just weren't as high as they were.
Well, you also had when the price does spike, Bob, you also have a lot of people who want to resell who give up, who say, I'm done with it. I'm tired of the roller coaster. I'm just cashing out on my silver. I mean, I see it that all the time in the comment section when the silver price has a huge pop. Oh, I can finally sell all my silver at a little bit of a profit or break even finally. I've been waiting for many, many years. I see people like that comment all the time.
Yeah, definitely. Yeah, no question. It, this has been a frustrating market, I think, for uh the retail investor out there, and not only that, probably for the professional investor in mining stocks. Going back to 2005, even where I mean, you look at some of these mining stocks over the last 20 years, they haven't done anything, but the price of gold has gone up, from 300 up to where it is today.
Yeah, 2,700. But what they don't tell you is that the mining company had to do a bunch of dilutive acquisitions to buy new mines, and then they had to do a reverse stock split. There's one silver miner that just did another acquisition, Coeur d'Alene, for our listeners out there. Like over the last 15 or 20 years, their old CEO, who's been gone a few years now, I think he did half a dozen bad acquisitions with reverse stock splits and share dilution. He pulled out almost $20 million in salary and stock options from the company while doing all these share dilution and then reverse stock split stuff over the 15 or 20 years he ran the company. That's why the share price wasn't good. Also, like you have the issues of the operational business of mining. So just because the metals price is at $2,700, Bob, doesn't mean that the profit margins are over $2,000 an ounce. I mean, we're pulling out 1 gram per ton gold now in a lot of these gold mines, and for silver now the grades are falling even faster than that.
Yeah, definitely. And I think that's one of the I think it's one of the reasons why I like, because I also run a hedge fund, in that in the fund it's basically mostly physical metal. It's 99% physical metal, held outside the financial system. And I did that because the idea of the cost of production continually rising, is only going to benefit and create this higher and higher floor for the physical metal versus attacking the profit margins, and capitalization structure of the mining companies.
Exactly. There's too many challenges for a lot of the regular mining companies. So there might be a window for a couple of years where they can have good profit margins, but then you run into a situation where the management team gets pressured into by Wall Street normally. Normally it's investment bankers calling them up all the time, like, oh, you want this extra debt, cheap debt, or oh, we can help you finance a new merger or acquisition. So it's pressure. So if you're Newmont Mining, a Barrick Gold, or some of these mid-tier gold miners, your phone's ringing off the hook at $2,700 an ounce gold. If gold goes to 3,000 or 3,500, the Wall Street investment bankers are calling or emailing you many times a day trying to get you to do these deals, these mergers or acquisitions. And normally they're not beneficial or creative for a lot of the shareholders.
Right. Yep, definitely. And that's something that I think for a lot of investors, they just don't have the time to read all the disclosures and sort of the different financial quarterly statements that come out and sort of the fine print of, like you said, dilution, warrant issuance, and that type of thing.
Well, also, they don't know behind the scenes that, like, even though the mining company is saying publicly and at conferences or investor presentation on conference calls that we're not going to do any deals, that the investment bankers are calling them up every single day saying, "Oh, we'll lower the debt cost. Oh, if the Fed cuts rates, oh, we can give you an even better deal on this acquisition, help you do an acquisition." So there's all this pressure behind the scenes. Wall Street is salivating now. The Wall Street banks are to go and help these gold miners do deals in the not too distant future. Let's hope that the management teams are more disciplined.
Right. Exactly. Yep. Definitely.
Well, I want to thank you so much for your time today, Bob. You know an enormous amount about the gold and silver industry. So, like the bullion dealers, the refiners, the mints, I think that's where you really excel at. I don't hear it all the time in all your interviews, but keep up the good work. I really learn a lot when I hear you talk about them.
Sure, I appreciate it. I definitely learned from you as well.
And if my listeners want to check you out on Twitter or follow your work, how do they do so?
On Twitter, it's Profits Plus ID, just PROFITS PLUS ID as in Idaho. And then our website, goldsilvervault.com. There's also a section on the website for media where interviews, articles that I write, that type of thing. So certainly you can try to get a little bit more educational analysis there. I'm one that's really big on trying to educate people, promote a very healthy environment, try to stay away from speculation and fear mongering, just try to help people along this sort of journey that we're all on, trying to understand, the financial markets, the debt issues, the currency debasements, and political scene, all that kind of stuff. These are all things that affect us all. So the more I can try to help people, I certainly try to.
It's the race to debase. I mean, like you look at the European Central Bank, China, Japan, the US. I mean, it seems like they're all trying to devalue their currency, and the central banks and governments, they don't want to cut back on government spending. And it looks like the central banks are going to start monetizing that debt in the central bank rate cutting cycle, that they're going to be adding more liquidity to the system, looks like to buy government bonds.
Yeah, definitely.